This week, the biggest IPO in history is about to hit the stock market. In my opinion, it is also one of the most important moments for everyday investors in years. And not for the reason most people think. SpaceX is going public, reportedly trading on the Nasdaq around June 12th, at a price that values the company near $1.75 trillion. That would be the largest IPO ever. And it is not alone. Anthropic, the company behind Claude, has already filed, last valued around $965 billion. And OpenAI is expected to file in the coming weeks. Put together, that is roughly $3.6 trillion of fresh stock hitting the market in a matter of weeks. The hype is going to be deafening, and that, in my opinion, is exactly when you need to slow down. Because here's the part nobody is shouting about. These rockets are launching into one of the most expensive stock markets in modern history. Quick note before we go on. This is education, not financial advice. I am not telling you what to buy. I am just trying to help you think. Let us look at the scoreboard. The Buffett Indicator, the total value of the stock market compared to the size of the economy, is sitting around 220%. Back at the dot-com peak, it was near 150. The Shiller-Cape ratio, another long-term value gauge, is near 40, a level we have really only seen once before, right before the year 2000 crash. And the 10 biggest companies now make up more than a third of the entire S&P 500, more concentrated than in 1929 or 2000. In plain English, a handful of giants are holding up the whole market. And when that few names carry that much weight, in my opinion, the whole thing gets fragile. And it is not just me being cautious. Even some of the people pricing these deals are nervous. When SpaceX filed, analysts at Morningstar argued it might be worth less than half of that $1.75 trillion target. Fortune pointed out it would need to grow its business something like 600 times over a decade to justify that price. Tech giants are pouring more than $2 trillion into the AI race, and respected skeptics from Michael Burry, the investor from The Big Short, to JP Morgan boss Jamie Dimon, have compared this moment to the months before the dot-com crash. I am not saying they are right. I am saying smart, serious people are openly worried, and that is worth noticing. Now, in my opinion, this is not 1999 all over again. Behind these prices are real companies with real revenue and real cash. Anthropic alone reportedly makes around $47 billion a year. That is why most analysts are not predicting a collapse. They are talking more about a 15 to 30% correction at some point. But here is the thing, a 30% drop still really hurts if you are not ready for it. So this is not about predicting the top. It is about making sure that whatever happens, boom or correction, you come out the other side okay. Because in my opinion, the investors who win the next decade are the ones who do not blow themselves up in this one. So let me share 5 ideas I personally think about in moments like this. Again, education, not advice. Idea 1, do not let the hype decide how much you buy. When something like SpaceX or OpenAI lists, the temptation is to go all in. Personally, I think it is worth deciding before the IPO how small a single speculative bet should be. For a lot of people, that is low single digits of their portfolio, not 20 or 30%. If one stock can ruin your whole year, that is usually a sign you own too much of it. Idea 2, cash is okay. Cash feels lazy when everything is going up, but in my opinion, cash is a position, it is optionality. When the market is this stretched, keeping a comfortable cushion in cash or short-term government bonds does 2 things. It softens the fall, and it gives you something to buy with when good companies finally go on sale. And historically, the best opportunities tend to show up on the scariest days. Idea 3, do not accidentally bet everything on the same horse. If you own a simple total market index fund, you might already have a third of your money in those same 10 AI giants, whether you meant to or not. In my opinion, it is worth balancing that out with things that do not all move together, like broad value stocks, some international, and high-quality government bonds. The goal is not to beat the market this year. It is to not get taken out by it. Idea 4, And this is the one I would change from the usual advice. A lot of videos will tell you to buy complicated options to hedge. Honestly, in my opinion, for most regular investors, that is a great way to lose money slowly. There is a simpler, safer version, and it is called rebalancing. Pick a target mix, say a certain percentage in stocks and the rest in bonds and cash, and a couple of times a year, sell a little of whatever has grown too big and top up whatever has shrunk. Quietly forces you to trim risk when everyone is greedy and add when everyone is scared without ever trying to time the market. No options, no leverage, no drama. Idea 5, keep investing, but slowly and steadily. Trying to call the exact top is, in my opinion, a great way to miss years of gains. So a lot of people simply invest a fixed amount on a fixed schedule, no matter the headlines, and let time do the work. And whatever you do, try to anchor it to the actual business. One honest question can save a lot of money. Is this company actually making money, or am I just buying a story? And about these IPOs specifically, 3 quick, honest truths. 1, the opening price is designed to capture the hype, not to hand you a bargain. 2, early insiders are often locked up for around 6 months, and when that lockup ends, a wave of selling can hit. And 3, you almost never have to rush. Some of the best companies of the last decade were actually cheaper a year after listing than on day one. In my opinion, it is completely fine to let the dust settle. Boring is allowed. So here's my honest take. The biggest IPO in history, plus a wave of trillion-dollar AI listings into one of the most expensive markets in a generation, that is a perfect storm for FOMO. Your job, in my opinion, is not to predict it. It is to make sure you can survive it. Keep your bets small. Keep some cash. Stay diversified. Rebalance instead of gambling. Keep investing slowly. Protect your money first and let the opportunities come to you. Survive the hot market and you get to be the calm one in the cold market that eventually follows. That, in my opinion, is the whole game. This was education, not advice, so always do your own research, and if you need it, talk to a licensed professional. I will see you in the next one.